everyone, I welcome you today on our regular streaming session on Tuesday. So I'm Stan, I'm a senior trading specialist at Exness, and also I'll be host today. So I'm a trader with pretty much experience since 2004, so I will give you in this session a couple of ideas and insights of how to read the market, how to analyze it, how to go top down in your analysis. So I hope that this session will be insightful and maybe interesting for you in some cases. All right, so let me make sure that everything works correctly. Just one final preparation. All right, I think it works. All right, so let's dive in a little bit of what was happening in the market lately. So of course the major event yesterday was the tariffs for Canada and Mexico imposed by President of the United States Donald Trump. Well, some people might think that now markets are reacting only on politics or solely on politics. However, that's not true. Markets are living with their own logic, and politics is just one layer. Of course, it creates volatility, uncertainty, and vulnerability of markets, which might correct and shift very rapidly, liquidate and make rapid sudden moves. Well, while that's true, but that's not all that is happening in the market. So politics is unpredictable. For example, on Sunday, if you were following the situation, Donald Trump also announced the crypto reserve, which was going to be accumulated with Bitcoin, ETH, and other cryptocurrencies. As a result, Bitcoin had soared 9% overnight. I mean, it's not overnight, just it was morning session, I guess. But later on, throughout the next day, this move was totally destroyed. So these paper profits were totally destroyed. So these moves were subject to speculations about insider trading, because the one big wallet had accumulated Bitcoin at the bottom, then it had unloaded it at the top, so that might have been insider trading, might have been not, maybe it's just a good trader with a very good market timing, but it looks for many people like it was insider trading. All right, so whatever. So politics is not our area of expertise, so we are not predicting political events, political actions, though guys, so watching the events that are going on so far. So I would encourage you to be extremely careful when you hold positions overnight, Saturday, Sunday, because on Saturday and Sunday, Donald Trump posts something in Twitter and X social network. So be careful about that. Volatility may be really, really sharp these days. All right. So without further ado, let's go to charts. So you see here Exness terminal, and let's go step by step, top down, and try to understand what's going on in the market. So for that purpose, we're starting, of course, with economic calendar. So it's posted here in our analytics tab in Exness dashboard. Go into economic calendar. We're clicking this link and getting here. All right, there are a lot of news posted for each currency, but we select USD in the first place because USD, American dollar, is our major benchmark, which we're referring to. All right, so today is March 4th, 2025. So we are scrolling down and trying to understand what will be posted this week. Well, first of all, of course, tomorrow, for those trading crude oil, there are a number of publications, petroleum status report, Cushing crude stocks, meaning that stockpiles of the crude oil, so they will be posted tomorrow. Well, usually if anything unusual or divergent is published on Wednesdays, so crude oil might make some moves. Well, we will get to crude oil a little bit later, but so for those trading crude oil, Wednesday is the scheduled publication, so be aware of that. March 6th is the initial jobless claims, which is not the official employment data, so it's a preliminary report, but still it might give some insights for market participants, though it's not the main report. Because the main is all of a sudden, so you know that, it's non-farm payrolls, which is going to be published on March 7th, which is Friday. So non-farm payrolls includes the data for the previous month, in our case it's February, and incorporates not only payrolls but also unemployment. So that's what is happening. So to understand better the picture of non-farm payrolls, what's going on, so let's go straight to bls.gov. So that's Bureau of Labor Statistics, and it is the official source. So in my trading, I often watch the official sources of information. So here you see, by the way, not only payroll employment, but also consumer price index, which is also posted here. We are clicking on payroll employment, and we want to see the graph, the chart. And let's filter it out a little bit to include the information only for the previous and this year. So you see that most of the time the number was beating expectations, so it was greater than expected. Though I think the previous one was a little bit weaker for January. It was a little bit weaker. So let's see what number will be posted on Friday. All right, on Friday. So going to tradingeconomics.com/calendar. So I use it for grasping the consensus forecasts and scrolling it down to Friday. So we see that, all right, here it is, non-farm payrolls. You see that consensus is 153. Forecast from Trading Economics is 150. So that means that usually it's expected to keep at the same level, maybe slightly higher, but obviously the same level like it was in January. So January, February is basically the same publication, the same posting. So if it will go down, so American dollar will get even more under pressure. So now it is under pressure, so we will get to that later. All right, so non-farm payrolls, as you see, is the dominant publication, the main publication this week, which is scheduled. Political statements are not scheduled, but economic data is scheduled, and that is good about economic publications. And unemployment rate was also, I believe, 4%. It was slightly better than anticipated. It was projected at 4.1 previously, and it has the real number was 4%. So basically, let's see what will happen this week. So consensus and forecast is 4% again. So if unemployment will stay at the same level, if employment will stay at the same level, nothing really substantial will change. So let's take a look at the sentiments. What's going on with the American dollar, with the benchmark? Okay, our main benchmark. So going to Exness terminal, DXY, so we are watching the DXY, which is the American dollar index. It's pushed down. Why it is pushed down? Well, we don't care about technical analysis on this stage, so all we care about is fundamentals. Why it is pushed down, what is the sentiment? And here we come to FedWatch tool, which is the probability tracker of the interest rates for certain dates for interest rate decisions for the Fed. All right, so here we go. Now is March, so for May, probability is pretty much stacked. So let's switch to June. June is 53%, meaning that the dovish scenario, the scenario which includes the decline of the interest rate for quarter a point, is calculated for 53%. So the probability of the scenario is expected to stay at 53%. So let's go to historical. What we care about is change. Trading is about change. It's not just about number. Last week, as you see, there was a parity. It was 47% for the decline, 37% for the interest rate staying unchanged. So that's close to 50-50. Well, of course, with a minor bias towards decline. However, it was not that obvious. So market was standing in the middle, somewhere in the middle. There was an equilibrium reached. So now, after the previous week, after the tariffs, talks and political uncertainties, so this probability has shifted. So everybody expects the Fed to lower the interest rate towards 4.25, and 56% of traders already discount for that. So when the market pushes from the equilibrium, so when something changes here in fundamentals, price action comes into play. Why is that? Because in this case, so you are expected to see the bond market moving. Okay, so probabilities of interest rates are measured by yields of government bonds and also currency swaps. Currency swaps are not available for the retail trader, because if you have Bloomberg terminal or Reuters dealing, so you might have this access. So you communicate with the bank, so they give you the rate, and you get the idea of what is the currency swap rate, real swap rate, not the swap rate which is deducted by the broker, but I mean interbank swap rate. But we have the public information, which is yields of government bonds. So that's completely real time. So that doesn't involve any paid services, any paid terminals. So that's absolutely free. It's posted on cnbc.com/quote/US30Y. Okay, so here is the link. So it's pushed down, as you see. American dollar is under pressure. It's pushed down. Well, that does not mean necessarily that other currencies are not under pressure. They might be under pressure too, but the weight of the American dollar is actually greater. So when capital stops flowing into the US dollar, so basically that strengthens other currencies. For example, Japanese yen, as we see it strengthening, Euro, British pound, and all other currency pairs. So just let's take a look what's going on. Currently, if you see GBP, JPY, so it's retracing from the support. Euro USD, it's retracing. It's just going up. No, it's 1 minute chart, sorry. Let's remove unnecessary everything that we don't need. Also, it's it's moving from the support. So that's what's going on currently. So let's start with Euro USD, by the way. So currently, this week and today, we see the shift that American dollar is slightly under pressure. It's under pressure. However, that's a very good question, whether it's a buy for Euro USD or not. Well, currently, if you see the current situation, so from the daily perspective, so yeah, Euro USD has been under declining trend, though this trend is not that long term. So it was a trading range basically since February 2023. And now it's building a base. The base pattern is a trading range, which is pretty long. So it was built since December 2024. Not very long, by the way, but that's a base pattern, the cup and handle pattern, in other words. So now the price tests the neckline of this formation. And that's a good question, whether it will be broken to the upside or not. So to better understand the market structure, let's build two moving averages like we always do. And maybe we'll just put not only two, but also three. Let's start with the big perspective, with the 200-day moving average. The euro is still located inside of the downtrend. Though it's pushed higher today, it's located inside of the downtrend, so price is consistently positioned below the 200-day moving average. So I don't think that's a dramatic shift, because for euro, by the way, interest rates are also expected to move down. So there is no such discrepancy, big discrepancy. For euro USD, the prices, the interest rate are expected to move down too. So let's just go to interest rates for Eurozone, and here it is. So let's put forecast here again, tradingeconomics.com. So you see that it's expected to move down towards 2% and maybe even less than 2% until the year end. So basically, it's also under pressure, as well as Canadian dollar, as well as euro, as well as British pound. So everything is moving down. Interest rates are moving down across the board. But changes for the American dollar are affecting the markets very, very much. So currently, as traders think that interest rate will go down as soon as in June, so of course money flows out of the American dollar, but this effect might be temporary because it was actually expected. So the question was only when. Whether it will be July or September. So now market thinks that it's June. Maybe that will change. So with that, I think that euro might not sustain this trend. So it doesn't look like it has still very, very strong performance. So now it tests the neckline. So, and a good situation will be for the market to test in this static resistance level. Here it is. So to continue moving down, to continue plummeting, or maybe going back to this range, what it needs actually, it needs to test the static resistance level, which is basically no more than a previous extremum. Nothing more than that. Previous extremum. So let's put 2 moving averages now. It's 20 and 50. So slightly lower perspective. So 20 is the number of working days basically inside of the month. 50 is number of, let's say, working days inside of the quarter. So these are two benchmarks which are very popular and many traders are using them. So you see that's a very logical bounce from the support. Now market is coming towards the static resistance area. So the moment of truth will be when the market will cross this level, and we will see whether it will be bullish trap or not. So I think that there is a pretty high chance of such a performance, such behavior. So let's monitor for the continuation above this level. And if it fails to proceed, so that might be actually the short opportunity, the pretty decent short opportunity, as Euro USD is basically still building the base. So base is not broken very quickly. Maybe it will ride higher for a while, I don't know. So that might not necessarily be immediate response to the downside. That might work like that. It might be broken to the upside. Then we will monitor for continuation. So this area is the problematic area of the high importance, area of our, I would say, high conviction. So we will start to monitor for the behavior of the price here at this area with the potential agenda to go short here. All right. So what about British pound? So it's slightly stronger. But stronger or not, also it tests the higher level, slightly stronger, right, than Euro USD. So of course it's already in the new peak when we have the new peak. So that's not a good trade location, because if you jump in, so you never know what's gonna happen. Whether the market will correct, it will stay rotating, it will continue going up. The number of scenarios is pretty big. So if you jump here, so that there's no guarantees that it will continue moving up. So usually the best way to follow the trend is to follow it on the support, which is in our case the combination of 20 and 50-day moving averages. So yesterday, for example, there was a day, the second day of recovery. Basically that's nothing really fancy. So if you want to track the setup, all you need to do is to find the good trend. In our case, GBP USD was actually pretty strong, so you see that it was moving up and up and up for the great number of days. So we have, by the way, here the so-called date range. It was moving up for 14 bars, 14 days, that's a lot. And the previous one was also moving for, I guess, 20 days, which also pretty big number of days. So this is a robust price action. So when this action pulls back to the support, when it shows you the responsive activity, the responsive bar, the growing bar or the growing candlestick from the 20-day moving average, or from the area inside of this combination of 20 and 50-day moving averages, so you can join at the second day, for example. Well, of course, that's already the history. So we are not supposed to do anything right now. That's already history, but you need to know those setups if you want to jump in with them. Yesterday, by the way, I was jumping in the USD JPY on the yen, and here it is. So I will already close this position. However, I think that still some continuation might be expected. Sorry about that. This is the same pattern, basically the strong trend located to the downside. Market is moving down, and that's basically the strong trend. But other than Euro USD and GBP USD, so our USD JPY is driven not solely by technicals but also by fundamentals. So later I will show you how it moves. So these are swings, strong swings, pushing it to the downside, pushing it lower and lower and lower, and market structure was so that the market was located below the dynamic resistance area for some time. Here it is, by the way. So yesterday it had touched the 20-day moving average. So now it was not so obvious yesterday, because when it was close to this level, 20-day moving average was slightly above the price. But that's not the case. You see that this is a very, very obvious test of the resistance area, very obvious test. But the setup itself, when I opened the position, was that I search for breaks between the third and the fourth day of the correction. So here it is. We have a low. We have day number 1, 2, 3, 4. Okay. So day number 4 here is expected. It's Sunday, so Sunday is not counting. So this bar is not counting. So this is Monday. So I'm expecting to sell at the fourth day because that's a problematic point. In this case, the trend either continues or breaks. If we have the continuation is actually pretty sharp. And you see that's a breakout or the break of this correctional move which happened yesterday. And we can easily put here Bollinger Bands indicator and track this situation. So price gets out of the Bollinger Bands. The price getting out is 150.70, 80, 158-ish, something like a 75, let's say. In order to calculate the stop loss size, for example, I use average to range indicator with parameter of 20. And the maximum ATR was 26 pips, 26 points. So if I place it on the $30 or $40 distance, so that would be decent. So my stop loss would be decent. So 75 and the peak was 33. Well, basically that's 50. That's slightly higher. But well, you're not supposed maybe to jump in exactly against the move, so you may need to wait until some kind of confirmation, maybe some bar stopping, bar closing in the red, something like that. If you have something like that, this bar, so you might sell it here. But currently what is good actually about the situation, I think that it's still moving down, so we might use it for a day trade because the targets are located slightly lower. I don't think it will go much lower than 148. Probably that's already too late. For day trading also, that might not be super good opportunity because it's standing right at the bottom of the Bollinger Bands. I would prefer to sell at the peak, at the top of the Bollinger Bands. Now it's at the bottom. But maybe if you switch to the lower time frame, so the situation might be slightly more interesting, because on the lower time frame the rotation might show you some decent entry points, something like that. If you see some market rotating back and forth, some false breakout to the upside occurring at the top of the Bollinger, so maybe you might time your position more properly inside of the day. For example, selling it here, buying it back at 148. Why is 148? So again, that's not an investment or trading recommendation, right? So that's just my opinion. But let's switch to the daily chart, and you will see that 148 is actually the area slightly beyond the Bollinger Bands, which is built here with a parameter of, I think, 20-ish, right? So 148 is the previous low, but basically I think that it's even possible to hold it lower, 147.71, something like that. So you see that this is the recurring pattern. Whenever the price violates the Bollinger, like it was here, usually the price action stops for a while. So now we are in a confirmed downswing for USD JPY. Why is that? Why it's even moving down? So not just because of the technical action, because it had tested the resistance area, that the trend was strong. Why is it so? What gives us the confidence that this pair, the currency pair, is actually moving to the downside? Well, basically we're speaking of differences between interest rates. We've been already monitoring the yields of government bonds of the United States, but let's see what's going on with Japan. Japanese yields or yields of bonds of Japan, 30-year bonds, they're climbing to the new peak. It's 2.3%. So was 2.3% on Tuesday, March 4th, according to the over-counter interbank yields quotes for this government bond maturity. So you see that's over-the-counter interbank yield quote. So it's the interbank market. So they capture that, they put it here in the form of a chart. putting it, the forecast here, the forecast is still 2.3, it's slightly lower, but currently the market seems to be pricing in the increase of yields. So when that happens, of course, the carry trade operations become pretty dangerous, right? Because you see that yields of the United States are diminishing. So the attractiveness of the American bonds are becoming lower. The cost of borrowing in Japan becomes higher. So with that, sorry about that, with that, carry trade operations become less lucrative and more risky, because if you see the yen strengthening, so your yield for carry trade operations diminishes. So big financial institutions, commercial banks, they often do carry trade operations, but they become more and more risky over the time as the time goes by. So previously, for example, with the previous year, 2024, 2023, the year before, carry trade operations have been one of the greatest opportunities for interbank market. Speaking of yields, for example, of government bonds of the United States, so you see that what was going on in late 2023 on in 2024, yields were close to 5%. For the American dollar and for Japanese yen, they still were low, but they're climbing higher, and yields for American dollar are getting lower. Of course, that creates a pressure for American dollar against the yen. That's very simple, right? That's very simple. It's like physics. So nothing is really complicated here. It's like physics. Capital goes to where it gets the greater yield. And the same is with the market, financial markets. Capital goes where it gets the greater yield. So in that case, of course, it's no surprise that USD/JPY declines. It moves lower, actually. By the way, we have economic calendar here. So there's a bunch of publications for the United States here, but also for Japan, we have consumer confidence, which is going to be published. It was published actually today, March 4, 2025. The actual number is 35, forecasted 36. Well, slightly lower than anticipated, but you see the market ignores the not very good data, let's say. It ignores the not very good data because when the consumer confidence is lower than expected, so theoretically it should pressure the yen, but that's not happening because interbank swap rates are really high, so capital goes to the yen and some carry trade operations are being closed. So that's exactly what's happening. So market is declining, so it pushes the downside bar. Maybe 47.75 might be the target area. So that's the area on the daily Bollinger, which serves as a resistance, support. So of course it's too late to enter the 30-minute chart on the 4-hour chart, but if you find opportunity maybe to find some pullback, maybe that might provide you with the short opportunity. So I will monitor for that continuation. So yesterday I've taken the pretty good trade actually for the yen. So opening it here, closing it here. There was a day trade. I was not basically holding it for overnight, but so because I was satisfied with my profit loss ratio, now maybe I will catch again another trade for this swing. Though of course if I held it overnight, so probably the result will be greater, so maybe twice greater than I have achieved. But that's not the case in trading. You know, that's consistency what matters. You might not need to take all the money from the table all the time, because that means monitoring your position overnight, carrying overnight risks and all that stuff. All right, what else do we have? So let's watch other instruments. Bitcoin. Well, Bitcoin was hit heavily after the announcement of potential reserve. So the verbal intervention by Donald Trump. So it has not held for the long time. You see that this was the only growth that happened because probably market is no longer believing claims of politicians. Well, by politicians in this case I mean Donald Trump, of course. That was crypto-friendly president. But now the narrative of him, betraying crypto, is evolving in the social networks, on Reddit, on in communities, on Twitter. Everybody starts talking that actually. So he's not supporting crypto. He's actually creating the bearish market. Well, I don't know if that's true. But currently, yes, we see only verbal interventions. We don't see any real actions. No real accumulation of Bitcoin, so no real reserve, just the talks. At the same time, the volatility in the markets is created by real actions, with tariffs being imposed on China, on Mexico, on Canada, and that's the uncertain part. So of course, the sentiment is pretty gloomy, so it's not holding at all. So it's keeping at the 83,000 level. Well, that's interesting. That's remarkable, because previously everybody was talking about market achieving 120 at least, because the sentiment was really strong and market was an accumulation area. Now it's no longer the case, so market is reacting, correcting down. The liquidity is drying up, and the very good question if it will come back ever again in the near future. Well, by the way, in February, as you see, Bitcoin was in the extremely low volatile environment, low volume, low volatile environment after the big liquidation which earlier happened here in February. So you see that the situation was really, really low volatile environment. I mean, probably the historically lowest volatile for the long time. Well, not speaking about July, of course, 2023. We had these situations when Bitcoin is actually standing inside of the range, not doing anything. Well, basically, that's the feature of Bitcoin. That's not a bug. That's a feature. Sometimes it just locks in long consolidations without any moves. Long consolidations without any moves. They are not infinite, so sometimes they break with a trend. So you need to be prepared with that. But basically, that's the feature of Bitcoin. If you trade Bitcoin, if you trade Ether, you should be prepared for that. Currently, I don't have any view for Bitcoin, so I think that we need to see some signs of price action escalating to both sides. So we don't yet have it. But speaking of the overall gloomy sentiment for stocks, and the Bitcoin in our case is also correlating with the Nasdaq, for example, and S&P 500 index. Nasdaq was pushed down yesterday by tariff situation, and it's driven down from the peak. So we might say that currently, at least maybe for today, the sentiment for both Bitcoin and for both stocks, American stocks, I mean, is keeping at not very good levels. So all upside breakouts usually lead to a greater sell-offs. You need to be aware of that. But Chinese stocks, on the other hand, so they are reacting more positively. So if you take a look at Hang Seng Index HK50, so you see it's feeling pretty well. Not just because the situation with DeepSeek, artificial intelligence engine, but also just because of the fact that the response of China towards the tariff situation was not very severe. It was just 15%. I think America had imposed 20% tariffs. China struck back with 15%, which is not the same amount of escalation. So in that case, Hang Seng Index keeps pretty well. Well, at the same time, not all stocks are moving evenly here. For example, Alibaba was on the good move. Baidu was in the range mostly, so it was not moving up. Tencent is keeping inside of the range, for example. Well, I would say that probably Alibaba is the major driving factor here. And Xpeng, which is traded on the Nasdaq, so it's also moving up pretty nicely. So Alibaba, Xpeng, and other companies that are driving Chinese market hard. Well, is it a good opportunity to jump in? Well, that might be, but at the same time, so you see that Alibaba had emerged from the base, so it was building the base for a long time. Now it emerged that that's basically, I think, might be the long opportunity, potentially might be the long opportunity. So put in here the moving average indicator again. Well, let's put just one, this time the 20-day moving average. And probably our course of action in this case might be to wait until the retest of the dynamic support, and maybe to initiate a position, to bring a position. So I think that might be actually a pretty decent idea. Maybe not immediate, that's not for today, but that might be the idea for the upcoming 1 or 2 weeks. Well, for today, again, as I've said already, so USD/JPY short might be the idea. And yeah, for swing trade, the idea might be for going Alibaba long. Okay, so let's watch gold. So as everybody trades gold, so gold, of course, is reacting on the situation with tariffs again and again. After the correction which had happened last week, so the correction was pretty remarkable, but today's action is pretty sharp too. Today's action was pretty sharp, and the second day of the recovery, so we might say that the gold is consolidating inside of the range. I don't think it will necessarily break the peak, but keeping in the range is expected scenario, is the scenario which probably would happen here. Because usually after such a big run, which we've observed for gold, and we've been speaking about that on previous streams, 58 bars. Okay, 58 bars. That's a lot, guys. That's a lot. And well, not 58 exactly, so it started to diminish earlier, but 57 bars. Well, that's a lot, and I think that shows the maturity of the swing. The swing is really mature. Let's put again here the market structure element, which is the 20-day moving average indicator. Now, okay, so price is standing at the support. It's standing in the dynamic support. So maybe the new swing will begin. But usually after such a big run, it tends to consolidate. It tends to consolidate for a while. Just take a look at how it responded to the previous big runs, to the previous big moves. So just taking a look at this action, again 75 bars was the record, I think. Well, not mentioning this consolidation, this coil inside, but again, so if you have the big run of 77 bars, that correction that is following. Now it's not 77 yet, it's 64 already. But I think that we might have reached the maturity here. Speaking of the situation with gold, so let's take the performance of the gold futures from the commitment of traders report perspective. With that, I will open now the barchart.com website here, and let's select gold. And this is basically, it's a weekly report. This is updated weekly, and it represents the amount of positions of big market participants which they hold overnight, which means open interest. Okay, so what do we see? Commercial traders are having the position of minus 2,083,000 contracts. And what does that mean, basically? So that means that the short position is pretty massive, though it's not at the record low. It was at the low here, and it was at the low at, I guess, September 30, but now it's not at the low. So maybe in order to find the peak for gold, it needs to go to the new low. Other than that, we might also watch the previous price action from the daily bulletin perspective from cmegroup.com website. So again, for futures. Let's select daily bulletin here, and what we want to know, what we want to see if, for example, the yesterday's action was accompanied with a growing open interest. That's what we want to know. For example, this bar is not yet calculated, but this bar, the Monday's action, is visible already in the daily bulletin. We want to know if open interest had grown or not during this growth. Okay, so let's go to metal products in our case. Metals, futures, products. And in our case, we need GC. GC is higher probably. Give me just a second. We have MGC here. Silver. Okay, it's higher probably. Again, 1 second. COB, it's cobalt. We don't need cobalt. We don't want to trade in that. We need gold. What we care about is gold. Comex, aluminum, Midwest, cobalt. It should be anywhere here. Comex, copper futures. Micro gold. Once again. It should be pretty big, pretty huge contract with a great number of entries. Comex gold. Okay, let's scroll it higher again. So why am I not seeing this contract here? That's strange. It should be here. That's interesting. Why it's not in the bulletin? All right. Well, I guess that we will check that later. Maybe we'll check that later. It's not in the bulletin just yet for today. We'll check that later. All right, so gold is the protection against uncertainty, as you already know. Also, it's driven by the diminishing the American dollar. So American dollar, the sentiment for the American dollar softens. So as expectations about the interest rate moves down. So of course, that's a support for gold. And another support for gold is geopolitical tensions and geopolitical situation, of course. So with that, of course, what you don't want to do, I think, is to go against the gold. Maybe you might make some day trade tomorrow, probably. The good opportunity for day trade was today, by the way. So basically, how is that working? So you build a Bollinger Bands indicator here. You track for the false break. You monitor for the formation inside. You take a false break from this formation when the price comes closer to the lower boundary of the Bollinger Bands. Here it is. And there you time the trade. For example, tomorrow the price action might be similar. You need to wait until it establishes the trading range, something like that it may be, and then it breaks it to the downside, pulls back, gets higher. That might be another opportunity to jump in, but that would be already the day trade. That's not a swing trade, so you are not supposed to hold it overnight because probably the agenda is very short term. So what you might capture here is just the upside move, which might be temporary. But usually, I think, speaking of the strength of gold, that would be decent opportunity. Why we're speaking of the strength of gold? Again, DXY is down, American dollar is down. Geopolitical tensions drive gold higher. It's standing in the range, so still pretty good space between the current entry point and the top of the range. So generally it might initiate liquidations, pullbacks to the downside. What you might want to do is to capture one of these pullbacks to take advantage of the volatility, in this case of the intraday volatility. But you're not supposed to jump at the peak to play the momentum here, because that's no longer the beginning of beginning of the trend. Today might be that might have been the course of action that might have worked, but maybe not tomorrow. Now, of course, it's already at the peak, so I don't know, maybe only scalpers can pick something out of that, but probably not day traders, not swing traders, because it's already at the peak. You're not supposed to trade at the peak. Well, you can do, nobody who can prevent you from that, but again, it's standing at the peak. Well, the price action is pretty similar across the board. American dollar is declining, gold is climbing, USD JPY is moving down, Euro USD is going up, British pound is going up, so everything is going up against the American dollar. That's the today's action. All right, so let's go to crude oil. Let's see what's going on in the crude oil chart. It's driven down again by the potential, fears of economic contraction, probably. The average price is still considered to be at 70. It's 70, so it now deviates pretty much from this price. There are no big news for crude oil still. Of course, this action probably is driven by political talks between US and Russia, because if sanctions will be lifted, so that means the increased supply on the oil market, on the gas market, which would negatively affect prices of crude oil and natural gas. That is a political probably kind of situation which was driven the situation down. But the overall average price of WTI contract, which works with the oil held in the Cushing, Oklahoma, with Oklahoma storage, is still considered at a level of 70. Going to EIA.gov again. So again, let's go to short-term energy outlook. We will again see that the average price is considered to be at 70-ish for 2025. For 2026, it's considered to be at 60. So it's expected to go lower to 60. And sorry. And for that, of course, I trade this move as maybe not very sustainable. However, oil is known for creating sharp drops, sharp liquidations, and sharp growth. So I will not be surprised if it accelerates or escalates really quickly. I don't know how deep, but I will not be surprised if it escalates. So I don't think it will be good to play against oil on the long side. Maybe you should ride the momentum, because crude oil is known as the momentum instrument. So momentum trading systems work slightly better on crude oil, because if it starts moving in some direction, it continues to move in the same direction. Again, it's incredibly difficult to time the trade in this case, so to find the exact moment to time the trade, because you see it never goes with a straight line, it consolidates instead. And again, you need to be patient in this case in order to time the short here, because it will stay inside of the range, then it will try to break maybe, and then it might go down. So if you want to really time the good trade for crude oil, you expect it to wait until the consolidation, I think. It's not just you sell at the low. Well, you can do that, but the effect might be temporary. But in order to time the good trade, so that's what you do. You find the bullish trap or something like that, the price retesting the boundary of the trading range, or the Bollinger Bands in this case, or both. And then you might find the beginning of the wave. So that's exactly what you want to do, but not at the bottom. Because if you sell it at the bottom, so in some cases it might continue shifting down, so you might catch some day trade. But in many cases, you will end up seeing the market locking in a consolidation. However, you see that's a momentum nature of this instrument. If it started to move, sometimes it moves smoothly, rapidly. So maybe the scenario might be different. So if you are risky enough, if you're a day trader, you might actually try to ride the momentum here, just placing the stop loss above the previous high, above the previous peak. As if it escalates, if it moves down, so you will get immediate reward here. But I prefer not to do that in my trading, because it's pretty risky. Momentum trades usually have less than 30% of overall hit rate, meaning that, well, you still can do that, and sometimes you can catch the big trade with a short stop loss, but the hit rate, the overall hit rate, is not very good in the long term, meaning that if you make 10 trades, 20 trades like that, so most of them will be closed by stop losses. So that's the harsh reality. So to avoid having that, you need to be smart in building your positions and timing your positions. Finding the better trade locations, finding the bullish traps, finding the false breakout opportunities when you will find the moment for the beginning of the wave, not being the not working with the continuation, but starting to time the beginning of the wave. That's exactly what you can see. All right, so what else do we have? What assets do we have? So we've been going through Euro USD, British pound. Well, let's speak about crosses a little bit. Euro pound. Well, the nature of this cross pair is basically pretty sideways with a minor trending component, meaning that it reflects the overall strength of the British pound, but actually that's a rotational mechanism. It can change over the time. So if you place a Bollinger here and increase the parameter a little bit to 50, you will see that currently it still has the capacity to go down until it reaches the bottom, but later on it may retrace. So currently if you trade with Euro GBP against Euro in favor of GBP, so you still have capacity for this asset to move down a little bit until it reaches the border of the Bollinger. And basically cross pairs, they work like that. They become oversold, they go down, become overbought, they go down, oversold, revert back to the average, become oversold, again revert back to the average, become oversold, revert back. Now we are in the downtrend. Maybe sooner it will become oversold, but we are not there yet. Yen pairs, if we avoid American dollar, if we exclude it from the equation, we see pretty much the same story. The yen is weak. I mean, the euro is weak. But here again we have the massive trading range. So I think that sooner or later the situation will break. That's a massive trading range which had started in August 2023 without any moves so far. So this situation points to a potential strengthening of the yen, not necessarily, but potential strengthening. And here you see the head and shoulders pattern, by the way, pretty visible. Well, it's not that I'm a big fan of head and shoulders patterns, but here I think it's pretty obvious. This one is pretty obvious. That's, first of all, it's a big consolidation, big range bound zone, which is building already for, well, I think close to 2 years, flirting at the lower side of this formation. So the break was already the price already tried to break this level. Now it's no longer here. And yeah, later, so if it tries it once again, to get here to this area, so maybe it might be the opportunity to escalate it to the downside, to try to bet on the short in order to see the escalation to the downside, maybe something like that. Well, I think that's pretty interesting. And that's, in this case, we're deviating from the American dollar, but the strength of the yen and the weakness of euro might be potential interesting opportunity. The same, by the way, I think with Canadian versus yen, with Canadian dollar versus yen, so it's even weaker. It's even weaker, and it's already at the bottom, so it's moving down, lower than the dynamic support area. In the downside swing, we are located in the massive downside swing without any pullbacks like it was in the USD JPY. Again, so in this case, if you see any pattern for entry, which might be, by the way, that's exactly what I'm talking about, right? You see the formation, market breaks above, that's a short. That's a short. So if you see something similar, market stands and consolidates, then breaks lower, So I think that might be pretty interesting opportunity, but you need to be patient to time this situation, because otherwise jumping at the bottoms doesn't work at all. Maybe for American dollar versus yen it would work, but for Canadian versus yen it is questionable. So I think that if you pick entries like that, it would be much better in terms of reward versus risk. Alright guys, I think that's pretty much it for today. So I've covered what I wanted to cover today. So let's sum it up a little bit for what we have currently for this week. So we have political uncertainty, which is obvious, that's not controllable, that's not under our control. In this case, what we can do, the best thing is to be careful holding positions on the weekends, because on the weekends usually Donald Trump posts something in Twitter and it pushes cryptos and may create gaps on Monday. So be careful about that. What else? We have the pressure against the American dollar. Last week it was equilibrium, 50-50. Traders were thinking that in June or July interest rate might not get down, but now they're thinking that it might go down. 56% of traders are thinking about that. So DXY, or American dollar index, is under pressure. The main publication which we are monitoring this week is non-farm payrolls indicator and employment and unemployment on Friday, which is NFP and unemployment. So it's scheduled at 150K. So if it will be lower than expected, American dollar may get under pressure again. Well, currently I think no matter what number we will have, DXY is still under pressure. That's how sentiment works. No matter what number will be really posted, market might slide down even greater. So gold is still in an uptrend, but I think it's in a consolidation phase. So you still have some capacity to capture some trade maybe tomorrow. To jump in, because now it's standing at the peak, so that's not a good trade location. But tomorrow, if you have the liquidation, the market correcting, you might try to capture the bottom. USD JPY, Canadian JPY, Euro JPY, they're all bearish, but you need to find entry points, so to time the trade. So that's the art and science behind the profit in such situations. Crude oil is also building some, building potentially drop, which we might try to fit in. But again, timing the trade is crucial. But I will be monitoring crude oil, because sometimes when it moves down, sometimes it just moves down, very rapid move. So I would be very closely monitoring for the crude oil specifically this week, because it's a momentum-based instrument. Sometimes it makes huge bars. Alright, I guess that's it from my side. Thank you very much for joining, for listening. So watch the recording, put us a like, and join us next Tuesday on the streaming session from Exness. That was Stan, Senior Trading Specialist.